Welcome to the MoneySaver podcast. Journalist Ellen Roseman and Canadian MoneySaver Editor-in-Chief Lana Sanachar interview leaders in personal finance and investing, as well as top bloggers, authors, and entrepreneurs. The goal is to help you save money and increase your assets. Learn how to make smart choices, safeguard your interests, and protect yourself from poor advice. Brought to you by Canadian MoneySaver magazine.
All opinions expressed on the podcast are the sole opinions of Lana, Ellen, and the podcast guest. This podcast is for informational purposes only and should not be relied on for investment, taxation, or other financial decisions. Please do your own due diligence or consult an advisor where appropriate.
Hi, everybody. Welcome to the MoneySaver podcast. We have a special guest for us today. He's Keith Richards. No connection with the Rolling Stones. Probably hear that a number of times, but he will give us some satisfaction when it comes to learning about how analysts view the stock market. And this is a kind of analysis that is less done than the fundamental analysis, where they look at everything to do with the company. These analysts are looking more at the data about the stock's prices and the volume of trading, and they love charts. And if you watch BNN Market Call, you will have seen him over the years. He's been a regular guest. So we're really happy to have you, Keith. Welcome to the MoneySaver podcast.
Hey, it's great to be here, Ellen.
I would say that for beginning investors, technical analysis probably just a no-go zone because they don't know about it and they probably would get confused if they did. But as you get into a more experienced frame of mind, you're more aware that technical analysis exists. And even though you might not be using it, you might be seeing a lot of references to it and figuring out whether or not you can use it well in your own investing, even if you're more of a fundamental investor. Perhaps you can define those two things, the fundamental analysis versus the technical analysis.
Sure, Ellen, I actually like to loosely define the two in simple terms as the what and the when. So the fundamental analysis process is trying to determine at least from a company point of view, not so much from a market point of view, but a company point of view, what we should be buying. What company, what stock, where's a good company versus an overpriced or poorly performing company. So that's the fundamentals. They look at all the earnings, the income statement, the balance sheet, the business itself, the growth, all that stuff. So that's the what. The when is the technical side. So at least in my company, ValueTrend, we start with the when because I own it, and therefore I get to. I'm the boss. So with technical analysis, we're looking at the timing of it. So we start from what stocks are breaking out, are beginning to show signs, or are entrenched in an existing uptrend. And so if they're in answering the question, when should we buy it? If the when is now, then I create a list of stocks that look like they're ready to buy right now. And then I pass it to Craig, my fundamental guy, and he does the what side of it. In other words, he determines if the company's actually truly worthwhile to buy. So it's the what and the when working together. And I think any investor, at-home investors or professionals like me, we have to use both. So that's hopefully a good definition of the two.
Yes, a technical analyst can be so sure of the data that you normally follow that you can say this is a good time to buy company X without knowing what company X does, right? And I've heard many examples of that where you don't really know what business it's in. You don't know anything about the management. You don't know anything about the market share, about the rivals. That's all the stuff that the fundamental people do. And it's harder to get out, whereas it's pretty easy to get your charts because you can get them all over the place on the web. Sometimes you have to pay more for them, but the charts give you that story. And in my time at the Toronto Star, I was the editor of the business section, and we had a technical guy writing, Bill Kerrigan, his name was, and people just adored his columns because they were very clear cut. And he'd always say, this is good, this is bad, this is not the time to buy, this is. Unlike many of the fundamentalists who say, well, on the one hand, and then on the other hand, and they're kind of dancing around. the fundamentals are leaving it to chance and leaving it to opinion too. Like, how do you judge the management? Only when they make a big mistake, and by that time it's too late. Where the technicals seem to be pretty quick at coming up with their analyses and then buying, because you don't want to wait too long after you've issued the buy signal, and then selling too when they think that's a good time to do it. But I think in general, we haven't done a whole lot about technical analysis on this show, and we want to at least give people a taste of what it's like. And I'm wondering, in your case, you've been in the investment industry, I see on your bio, since about 1990 in the brokerage world. How did you get more involved in this kind of investing?
Yeah, that's a great question. It's funny because in 1990, for the first few years, I sold the evil mutual funds because I didn't know any better and I was a novice. And so, you and I have talked about the inefficiencies of those products. But in 94, I started to actually on my own, and the whole industry was focused on mutual funds at the time. But I on my own began to realize the inefficiencies of the mutual funds. And so I wanted to learn how to buy stocks. And of course, you take your Canadian securities course to start off with in this business. And you're pushed towards the fundamental analysis side. But I wasn't finding much success, especially reading the research from the firms that I was with at the time, because they were always wrong. So what I did was I went to the best broker in the company I worked for at the time. He ended up inspiring me. I read a book that he recommended called How to Make Money in Stocks, and everybody should read that book because it combines fundamentals and technicals in a very simple way. William
Who's the
O'Neill.
author?
William O'Neill. And
Oh,
he
yeah,
created,
he's the business.
business investors. What is it called? Yeah.
Investors Business Daily.
Business Daily.
In the
Investors
US.
Business Daily. So yeah, he created a formula, which again, he wrote this book I read it in like 93 or something. So it's been around a long time. But he created a formula called CAN-SLIM, and each letter stands for something. C stands for current earnings, A stands for annual earnings, N stands for something new. So these are the fundamental things. And then and some of the other letters stood for technical factors, which are price, momentum, and that kind of thing. So I went on to study it, and I originally took a course. This was another great moment in my life. I took a technical analysis course it was taught by the greatest technical analyst on earth, acknowledged, the granddaddy of it all is Ralph Acampora. And I was just early because technical analysis was voodoo at the time. And I learned from the greatest, he and I went to lunch. It was a 1-week course. We went to lunch every day. And he told me, Keith, you're so enthusiastic, you got to go your CMT. I became the 40th person in Canada. Now there's a few thousand of us, but I was the 40th to get my CMT in Canada. So it was a really early adapter. I used to fight everybody on it. Everybody would say, oh, it doesn't work. It's voodoo. It's just a bunch of squiggly lines. Around that time, there was a book written and it was called The Random Walk Down Wall Street. You might remember that book, Alan. That's right. And the book should have been titled Why I Hate Technical Analysis, because the whole book was that you can't predict anything,
And that was the idea of throwing a dart against the wall, and whatever you come up with, you should buy.
So I won't get too deep into it, but the comments at the time that he made in the book, because I did read the book, I wanted to find out why he didn't like technical analysis, is that he was saying, well, we took a computer and we had to generate some random price points. And when we showed it to a technical analyst and he drew all these lines and showed us where the price is going to go. And so I remember I turned to the guy that I was partnering with in my office at the time. And I said, he's just using random numbers. Technical analysis uses price created by real crowds of people with all the human psychology of fear and greed and fear of missing out, as they call it now, and all these things. He's just using a bunch of numbers. So we're not trying to randomly extrapolate anything from random numbers. We are looking at price that is driven by human behavior. And that's really the essence of technical analysis. I am reading right on a chart using volume, and I'm also using sentiment indicators. We can talk about that later. But just data that tells us how people are thinking. It's a human psychology. I study sentiment stuff. Again, one of the early adapters in Canada on that. And it's sometimes now called behavioral finance. So that's kind of my specialty. But even just basic chart analysis is, what's the crowd doing? What are they thinking? Are they fearful? Are they greedy? Are they complacent? Or is it somewhere in the middle? And then once we read that, we can try to figure out where the stock is going to go from a momentum perspective. So hope that helps.
Yeah. And as well as managing clients' money or helping to do that, plus, run your firm in Barrie, Ontario, you also put out a newsletter on a regular basis. And those newsletters are really interesting. And you do interviews on video for the edification of your clients. And you and I just did one recently. And you go on TV, you go to the Money Show, you probably write articles in Canadian MoneySaver. That's a pretty busy life. I hope you have time to do it all and still have balance.
Well, I love it, right? So yeah, my drive as I've gotten older, I've been in the business since 90, and here it is 2024. So built a good business, and now I'm really interested in helping to educate the common investor. It's kind of been, I've made my money and I've got my business, and it's all in, and I love it. I love doing what I do. But now I kind of have a mission to help people, ordinary people, learn to invest, which you'd think would be counterintuitive, me as a portfolio manager. But actually, I find that I get enough business anyways from referrals that I'm interested in helping the little guy who maybe doesn't even have enough money to deal with us, right, at ValueTrend, still use some of the tools. So I've written a few books, and yes, I write a blog. I've been writing that blog for a long time, and it's got a huge subscriber list, and it's on technical analysis, and I talk about what the markets are doing this week and what should happen. I kind of give away a lot, but it's all part of that community learning. And recently, my biggest pride is that about 2 years ago, I developed a technical analysis course, and it's an online course. And I priced it so that ordinary people could. It's literally my life's experience and knowledge and my trading system, all in one basket, effectively, through a course. And I charge less than $400 for it. It's not a profit for me. It cost me $1,000 to make the course, and I probably almost broken even on it. So it's not it's more my mission right now is to help people, ordinary people, learn to invest. So yeah.
Do you use videos as part of the course?
Well, the whole course is online with videos. Yes.
Okay, very good.
Yeah,
and I got your current, it's your latest book, I guess, that's been published, aside from this one you're still working on, called Smart Money, Dumb Money, Beating the Crowd. And it's quite a good read. I'm really enjoying it. And you can find it on Amazon quite easily.
Yeah, that's my latest book. I would think if you're a beginner investor, like a newer investor, or completely initiated in the art of technical analysis, I would read my book sideways.
Okay. I saw that on Amazon as well, but there was no electronic version.
This is the newest. I did a second edition. This was my bestseller. It actually became a pretty big bestseller for me. Stayed on the list for a long time as a bestseller on Amazon. And it's because it's a book directed towards the ordinary investor. And I've just revised it because some of the charts were old and stuff, but it's effectively this book you could read 20 years from now. It'll still be relevant because it's the basics of technical analysis. My other book, Smart Money, Dumb Money, you were just talking about, that's sort of the next level stuff. Okay. And that's on the sentiment stuff, the crowd behavior stuff. I would read sideways before I read that Smart Money, Dumb Money, because it's a little bit more technical. You probably noticed that, Ellen. It's filled with charts, and it maybe isn't the first thing somebody should read if they're trying to learn technical analysis. Read my sideways book.
Okay. Also, when you use the term smart money, dumb money, people might find it offensive. Like, are they part of the dumb money?
Yeah, well,
I used to recommend all the time people read Investing for Idiots or The Idiot's Guide, and people said the title put them off so much they would never read it.
Yeah, I used to get comments like that, but so here's the reason I called it. In fact, my videos that I do one a week on my website. It's called the Smart Money, Dumb Money Show, and So the concept is that there are indicators that technical people like me use, and this is deeper down the rabbit hole that I'm going to talk about today. But I can look at flow, at money flow, okay, of smart money, and that's like large trades. Like a retail investor, even if they've got $1 million or $2 million, is still tiny compared to the teacher's pension plan, which is a multi-billion-dollar portfolio, right? So when they do a trade, it's like a zillion, I'm exaggerating, a whole bunch of shares. And when even with the guy with $1 million trades, he might buy 5,000 shares, which might be a big trade, but in his mind, but it's small compared to the institutions. So, and the smaller the trade, usually the smaller the investor and the less informed they are, because they're, so what we do is we track institution flow, and large trades, stuff like that. Hedgers, commercial hedgers. So these are people that run a company like Barrick Gold and want to hedge the price of gold. So they're smarter about their business, like gold, for example, than you and I are, right? So they're called smart money, all these institutions. And then the dumb money is not actually dumb. It's not like they're a whole bunch of people with half brains or half wits. What it is it's ordinary people, the retail investors, and they're not, as when it comes to investing, not as informed as teachers' pension plan managers. As simple as that. Like the teachers' pension plan has the best in the world, some of the best in the world managers. So Omer, same thing. So we pit their flow, like, which we can track through ETFs and mutual funds and that kind of flow, and small trades like 200 shares of a trade. We know that's a retail investor. That's not teacher's pension plan. So we pit them against each other. And what we see is that when there's a whole bunch of small investors moving in one way and the institutions and whatnot are moving the other way, often they move together because the market's going up, everybody's participating. But when they start moving opposite, then yeah, that's bad news, because if the institution is getting out and the retail investors are piling in, which by the way is the situation as we speak, then there's a heads up. It doesn't mean tomorrow the market's going to fall, but it does mean that there's that somebody that's smarter than me and you are selling, and the others who are not so informed are buying enthusiastically. So that's where the term smart money, dumb money comes from.
So we're filming this in mid-February, and we've just had a really big rally, which looks like it's at least stabilizing for now. And much of the breadth of the rally in the S&P 500 in the US major stock index has been in 7 stocks, which we often call the Magnificent Seven, which all seem to represent the technology industry, IT or AI. And there's huge optimism and excitement about this by investors usually. There are some people like Toronto's U of T professor Jeffrey Hinton, who at the end of last year became kind of worldwide famous for saying that he was really worried about the prospect of AI doing bad things in society, and it should be more regulated, we should slow down, and we should just use it because it's there. But we're kind of at a turning point where these stocks can continue going up, or at some point the bubble will burst. And I don't know if you have any idea what will happen to make that occur, but are you predicting that probably a correction will happen just like it did in 2000, when we were also excited about Amazon and various other internet stocks?
Well, I actually don't think we're going to get another tech bubble crash like we did in 2000, because in this case, yes, they're overvalued. Yes, they're overbought. So technically the crowd has moved into these stocks too much. So irrational exuberance, as Greenspan would have called it years ago. Templeton said, to buy when others are despondently selling, and to sell when others are greedily buying is the best thing to do. I'm not quoting him properly, but so there's a whole bunch of people greedily buying these stocks, okay, and institutions too, by the way. But it's still not a tech bubble, because if you go back to 99, and as I said, I've been in this business forever, so I was live and in Technicolor managing money during those years, and it was a rush into garbage. There was good companies people were buying, but there was also a lot of global crossings. You remember them? Like there was, Juniper, like these guys were not, like, they were so overvalued, and they were really not producing the goods. Like global crossings, they want to put cable across the ocean. It just wasn't a profitable venture to do that. So I mean, but the people were so fanatic that anything even smelled like internet at the time. And
That's
see, the
right.
internet is real. Everybody uses it, right? So
And there
it
were a
was.
lot of retailers who weren't doing so well, so they decided to go online and become online retailers, and they still didn't do that well.
That's right. I mean, Amazon did a great job, but nobody else really did. So, so is it the same as the tech bubble? No, but is it overbought in the moment? Absolutely, without question. Okay. So does that mean that Keith just said the market's going to fall tomorrow because it's really the Magnificent Six, because Tesla's already started falling. But let's say the Mag Six are overdone and they're all going to crash. They're all so high. But no, I'm not suggesting the markets are going to crash. I think it's going to correct. I can't say it's going to happen this week, next week, week after. Seasonally, there's some stuff in place, and we can talk about seasonals if you want. But because everything's so overbought right now, I wouldn't be surprised if we got a 5% pullback or something like that, but not a 50%er like we saw in 2001. So that's my comments, is that, and then I think during the second half of the year, because per your comment, Ellen, breadth, which is the participation on the markets, something that I quantitatively follow on a regular basis using all kinds of indicators. You read my books and you'll learn all about them, but basically breadth is lousy. Like, it's all about, a dozen stocks, and six in particular, but it's a dozen stocks that are doing all the lifting, and the other, 490 odd of the S&P 500 are doing very little, right? And that's not healthy. That's not healthy for the market.
There's another trend. You were talking about how the retail investor puts in an order for 200 shares, but many companies these days now allow fractional share trading. And so people might be buying like, $50 worth of stock whose trading price is $500. So that gives them the ability to get into these companies that they might not have been able to before. So it's, I guess, just another way that the current trends have to be factored into your framework.
Yeah, it's again, but that is a sign of retail money. I mean, I don't want to call it dumb money, because some of these people could be engineers and university professors. They're the smartest people but it doesn't mean they know anything about investing compared to, say, Warren Buffett, or even a hedge fund, which there's a lot of really smart, Stan Druckenmiller is a great example of a hedge fund kind of guy that really knows his stuff, right? So you're not as smart as them on the investment field, even though you may know nuclear science better than him. So you follow him and you fade, what we call fade. Let's do the opposite of the small money, because at peak moments, the small money is very wrong, and the smart money, or sophisticated money is probably a better word, is very right. And when they're opposite. So that's one of the things I do, and I write about in my blogs, and I written a book and all that stuff. It's a big part of the equation.
Yeah, you're talking about the fact, I guess, that there's a real lag in information till it gets to the average person. And when they, the common wisdom is, if the taxi driver starts asking you about a stock that he's heard of, that's not a good sign. Or if somebody's on the cover of Time magazine, that means their time is over.
Yeah.
Retail investors do hear about it later. And by the time they convince themselves it's time to act, they might be right at the very end of the trend, or it might have turned already without their realizing it.
The retail investors that are watching this, ordinary people, meaning that's my lingo for ordinary investors, retail investors. Okay. There are some tools that they can use to actually get the jump on just listening to the cab driver talking about how he's buying NVIDIA now that it's, 80 times earnings or whatever it is, So what we can look at trends. So we look at breakouts and the angle of ascent on the chart. All these things can give us clues that things are maybe getting overbought or oversold, great opportunity. We can also look at simple sentiment indicators, like looking at the crowds. And one I'm going to give you right now, it's absolutely free. Every person watching this can use it. In fact, I use some very sophisticated data feeds. I pay, 50 grand a year for as an institution, but quite frankly, this indicator that I'm going to give you is free, and it uses some of these exact feeds that I'm paying big bucks for, just as a broad scope indicator. It's the CNN Fear and Greed Index. It's free. Go to their site, type in
Just read about that in your book.
Yeah. So it's a freebie, right? Now, I also free once a month at the beginning of every month on my blog, and you can subscribe to my blog. And I put what's called my barometer. And remember, I'm not going to talk about, it's not proprietary. I hate that word, as you know. It's just made up of a bunch of indicators that are commonly accessible, but I've put them together in a unique way. Although I disclose how to do it yourself in my book, Smart Money, Dumb Money. So I don't believe in like, there's no secret, you just, I print the reading of the barometer at the beginning week of every month. And all it does is sort of like the CNN thing. The one thing I like about the CNN Fear and Greed indicator is it complements my barometer, because my barometer uses things like breadth, we were just talking about, the participation in the markets, and the fear and greed thing looks more at momentum, like how if things are moving too fast, right? So putting them together, they're actually a pretty good indicator of the risk on the market. Now, I must warn you that for the sentiment, the risk stuff, it is really just an indication. It's not a signal. It's sort of like, you see dark clouds in the distance and you think, well, maybe that's a sign of a storm coming, but the storm's not on you yet. So it doesn't mean you immediately put on a raincoat and get an umbrella, because it hasn't even started raining. Okay. So to find
I
out
think
what
the
the rain
proprietary part that you did was call it the barometer, which is a cute name. And you have to remember, it's not barometer, but barometer.
Yeah, barometer. That's right. And
we'll put all these references onto our episode page if you want to look them all up. We'll put links to everything that Keith does.
Yeah, you can go to my blog. But I mean, the retail investor, again, sorry, it's not a put down. It's just ordinary investors should read my book sideways, because it'll teach you the basics. And the most important thing that a retail investor, even forgetting the CNN Fear and Greed and reading my blog every month about, for the barometer, what is important is understanding what price is doing. Individual investor has to understand these two principles. One is that there's always support and always resistance of a stock, a market, a commodity, whatever, bonds, whatever you're looking at. And this support is where buyers come in, and resistance is where sellers come in. Okay. Now let's just call this $5 and this $10. It's just a random example. Well, what happens is that people bought this stock, as you can see, around $5. It went up to $10, and then people started selling it. Well, you'll notice here it was $10, and they sold at exactly that point there. And the reason they sell is because they're saying, well, the last time it got to $10, they sell. The other reason, though, is these people bought it. Like, whenever there's no such thing as only buyers or only sell. For every sell, there's a buy. Somebody bought it at the same time as somebody sold it. So somebody, there's a whole bunch of somebodies, bought it at 10 here, and what are they thinking? Oh man, if I can ever get my money back, I'm going to get out of this stock. So as soon as it hits $10, they go, that's it, I'm out, and they sell, and they create selling pressure. So the stock goes down. It's just, see, this is why when I talked about that random walk down Wall Street, the person that wrote the book, sorry, Malcolm, whatever his name he was forgetting that real charts are about actual people and institutions and whatnot trading. It's not just some data points. So this is here to support, because people are going to buy this as close to $5 as they can, because they go, oh, wow, did you see last time it was $5? It went up to 10. So they want to buy it. And they do, and it goes back up to 10. Oh, these people that bought here, because somebody bought, remember, there's no such thing as one-sided trades. They're going, oh, I want my money out. So they want their $10 and they sell, and the pattern repeats. Eventually that breaks out, okay? Real world examples is like here. I'm trying to get, here. This is the S&P 500 between 2014 and 16. You can see support, resistance, support, resistance. You'll see this over and over again. I'm going to quickly jump. Okay, so this is the TSX. This is the chart that I had for your group. It hasn't moved much since. There was resistance. You can see, look at that, boom, boom. On the TSX, it was hitting 20,800 over and over again. That's resistance, all right? So was it magic? Was it random according to, the random walking up? No, it wasn't. It was people remembering whatever they paid for their TSX portfolio, and they went out as soon as it got there. But it went down here in this range, and people would buy it again. This is real world stuff. So, you can see it this is the banks. Okay, look, support, resistance, but then they break out and things change. So this is
break
right.
out down.
Yeah, they can break down or break
Yeah.
out, right? So you just never know. So this is a long-term chart demonstrating that. This is going back to 1890 or something like that. If that's not enough data for you, I don't know what. And it shows you there's been many periods of time where with the Dow, this is the Dow Jones Industrial Average, went sideways for like 20 years, 15 years, 17 years with no new highs. Okay, so in between there's bull markets. This one lasted 16 years, this one lasted 17 years. We're about 8 years into the current one. Okay, so we could last a few more years in the true bull market. But I'm trying to demonstrate that the principle of support and resistance, it's people remembering what they paid or what they missed out on, and that's why it happens. Now, the other principle that I want everybody to pay attention to, and then I'll shut up and let you talk again, Ellen, is the principle of trends. So a trend is identified by higher highs, say an uptrend, higher peaks and higher troughs. A downtrend is lower peaks, lower troughs. Like, I hope this isn't too complicated for people. Up is good, down is bad. And you identify that by the peaks and troughs. You need 2 in a row. Okay, 2 consecutive peaks, 2 consecutive troughs. That's a trend. And so the strategy here is every time it hits the trend line, you draw a line, you buy it. In this thing, if you're in a downtrend, you should be out to begin with. But if you're not, at least try to get out of the next peak. Okay, and then in between there's transition, and we call that a base. All right. So if I try to flip through, and here's what a base looks like. It's exactly the same drawing, but you'll notice these 2 peaks are no longer either making lows in this case. So this peak and this peak were the same. And this trough, actually that trough was higher than that. That's an indication we're breaking out of that downtrend. And when it finally breaks out past that last peak, we have a new uptrend. And that's where guys like me step in and start buying. So I always say, when people say that, oh, technical analysis is about market timing, no, market timing is about knowing exactly where the bottom is and exactly where the top is. But what I can tell you absolutely is what crowd behavior is doing, and the odds of success increase when you buy on a breakout, because that means that these sellers, remember what resistance is created by is sellers. These sellers have been taken out. There's some good news on this stock or this market that's getting everybody excited. And even when those sellers started selling, the news was good enough to drive through them. So hopefully that, then I don't need to share any more on that, but hopefully that explains the basics to people.
Right. I read a number of commentaries in the last year or two about these very big, Magnificent 7 or 6 or whatever they are. And before that, it was the FANG stocks, that they were taking up they were creating much of the rise in the index. And the other stocks, the 93% that were left, were just doing nothing. They were in a stabilizing or consolidating position. So that might show that there still has to be a bull market for them eventually.
Oh yeah, in fact, what Craig and I have been doing in our managed accounts that we run is we've been we have some cash because we do think the market's probably overbought and may pull back in the next few weeks. But the other thing that we're doing is we're basically completely avoiding the Mag 7s and anything even that smell like the Mag 7s, and we're buying value, because the value stocks are so undervalued from a fundamental point of view, and technically a lot of these things. So remember, we don't care if it's just fundamentally good. Like, we're not just, oh, that's a cheap, well, it could get cheaper, right? So we don't want a cheap stock that's going to get cheaper. We want a cheap stock that's breaking out, like we just saw on the chart I showed you, right? So we're starting to see some breakouts happen on some of these sectors and stocks that are undervalued, and technicals will show you when that's happening, rather than just saying that looks cheap. You can buy cheap stocks that are actually starting to move up after having been depressed for so long. And those are big winners, by the way. The other thing you can do is avoid the stocks that are so overbought, like the Mag 6 or 7, that you can start to not necessarily short them or anything, but at least you can avoid them and start to move your portfolio into the cheaper stuff.
Right. I think some of the discount brokers, the online brokers, are using technical information to help their retail investors in a way that aggregates a lot of different things and then gives you a green or a red, and giving you a sense of, is it a good time to buy? That would be more helpful, I think, and more easy, at least, to manage for the beginner. And then eventually they might say, okay, instead of getting it all aggregated as one, I'd like to go back to the originals. So where would they start in terms of doing some of this research on their own?
Yeah, where do you find your buy list? So I did a whole section in my online course on that, because that's a puzzler. You know, I the VectorVest is a place. I actually mentioned that on my course. I'm sorry, the name escapes me right now. I guess I should have prepared. We can probably put it in the footnotes because I'll look it up. But there's another company that does US only stocks that is pretty good for finding buy candidates. They're all fundamentally screened though. So you have to use the technicals, the stuff that I do, to find out if it actually is moving. And even if they say they're using a technical aspect, they're not as well as they should be, because it's all just part of a formula. And quite frankly, Craig and I have a full stop. If it's not technical, we're not buying it, no matter what. Even if it's just one factor in this screen that they're doing, that's just a factor. Whereas we are like, look, if it's not, the charts are not telling us this stock's going to go up, we're not going to buy it. I don't care how good a bargain it is, right? So that's the difference here. But there are different companies that will give you these fundamental screens. And if you learn the technicals through reading my blog and just, spend $10 and buy that book that I wrote, it's called Sideways, you'll know enough to be dangerous, as they used to say. You'll be enough to be well enough informed that you can probably make good technical decisions on top of the fundamental ideas that you're looking at.
In your newsletter, what kind of areas do you try and go over? Is that also seen as education for a much wider group than your clients?
Yeah, so there's kind of 3 touches we do for public consumption. The big one is the blog, and it's you go to valuetrend.ca and you'll see the blog. Click the blog thing, and you can look at all the old blogs, as well as you can subscribe, or just if you don't want to subscribe, the subscription, we don't harass people. So if you subscribe, we'll never email you. Like, it's just so you get it in your email box, right? The blog. But the blog is very popular. I've been doing it for a long time. I've got many thousands of subscribers, as well as many thousands of individual hits. And it's twice a week usually, and it covers my thoughts on the market and what sector. And I talked about oil the other day and things like that. So you can look at the blog, just get it in your email box, and you can read the title and read the first opening paragraph, and you decide you want to read it, do. If you don't, then don't. But it's very educational, because I talk about the principles that we're talking about. And then from there,
I read the one that you did about banks, because it was our investing club, and I thought I would use it. And you were very straightforward about it's not the time to buy banks, and I wouldn't buy them right now, showing the charts. And then the one that you thought might be a breakout was Bank of Nova Scotia, because it had gone down quite a bit and it had more room to move up to the others. And that's helpful. People want to know that kind of stuff.
Yeah, actually, so good example. We have been trading, not buying and holding. We have been trading TD Bank, and it's got this, that support resistance pattern we talked about. It's been going, up and down from about mid 80s, like 85, 87, to the mid 90s. And I'm not advising anybody here to go out and do this, because then the day I tell you to buy it, they say we're buying around 86 or 7 or whatever, and then you'll buy it and it'll go down to $50, and then you go, that key, because we'll do this amongst 25 stocks. But we sometimes just use that support and resistance pattern, and we just assume it's going to continue. And so, and especially if it's a good company, like TD's not a company that's going to go bankrupt tomorrow. So we know that, it's not likely to have major problems. So we say, okay, our risk is fundamentally low, and technically, well, if it breaks too much below 85, we'll sell it. And that's one of again, we have to have a sell discipline, not just a buy discipline. So again, big topic, you have to read my books or take my course. But all of this stuff, we don't think the banks are buy and hold. But we do love to trade them. And we've got 2 banks going on right now. We've also got another bank that we're in for a good time, not a long time. So stocks that are in uptrends are buy and hold. There's stocks that are looking good, and you can hold them for a couple of years, but the banks aren't one of them.
The stock that I remember was, like $25 for a long time, Bombardier, and then it went down to under 5, and then it's huge volume. So people are trading it all the time because it never seems to go above $5. And I don't know if, that's a worthwhile use of the stock market, but if you've got the time and the energy to keep following it and to get in and out, well, good for you. You can make some money.
Yeah, to me, we're very pragmatic, and that's another thing that I've lectured on. I get on my high horse sometimes. But one of the things that I see in retail investors, in dumb money, whatever you want to call it, is they get caught up in themes, thematic investing. Oh, EVs, it's all about lithium. You got to buy lithium or whatever it is. Well, and that's what created the tech bubble. That's also what created the oil and gas, bubble in 2007, when it went up to 147 bucks a barrel. Well, here we are today, oil at 70 odd dollars, right? I mean, every bubble is created by themes. Remember the marijuana theme? Oh, they legalize marijuana, everybody's gonna be smoking pot. Well, maybe everybody does smoke. I don't smoke pot, but everybody does lots of people use cannabis right now for different reasons. But it was a non-profit business to be in. Like, it's a really expensive. So they didn't take, there's just a theme. Well, everybody's gonna smoke pot or whatever. So
and as soon as marijuana was legalized, all the stocks dropped. And even the ETF that had it, it never got up to that price after the legalization. It was like buy on mystery, sell on history.
Yeah. So that's the problem with thematic investing. And I really would suggest that people follow the charts and follow the sectors. So you can look at, say, Spider, SPDR. They have sector ETFs, and I chart them to see what the sectors are doing. So no themes. Who cares what Elon Musk is saying? Or if you believe that, I don't know, name your favorite. Well, the AI is a theme, by the way. And it's true. Like, AI is great. But, it comes to a point where it's sort of like the internet. It's like, well, yeah, okay, but everybody's got it, and there's nothing, the excitement's over. So that's, you have to be really careful with thematic investing, because sometimes it skanks you, like.
And like you said, with the cannabis and also with the AI, a lot of these are startups. They might be very big firms, but they have really not a whole lot of history of managing it. And we had that week or two after, no, it was in the fall, when OpenAI fired the president, the CEO, and he was gone, and then he was back, and then he went to Microsoft, and so much drama for a big company. And we're still not sure if it's going to stabilize, but it kept us all in suspense, wondering why this very successful company would get rid of the CEO and not even tell anybody about it, why it happened.
Well, that's so maybe we could conclude by saying that the essence of investing is to be pragmatic. And that means, like you mentioned, I don't know if that's a good use for the stock market. Well, the stock market is simply not there for use. You're there to make money on it, full stop. Like, you can be environmentally wonderful and only buy ESG stocks or whatever it is. But if at the end of the day, it's not going to make you money, like Craig and I, we just believe fully that we have a job. It's to protect capital. If the money's going down, if the market's going down, or the sector's going down, or the stock's breaking down, we want out. Okay. The second thing is to make a reasonable rate of return without too much risk. And that's all we should be focused on, not whether it's a thematically green stock or a thematically everybody's going to smoke pot kind of deal, or whatever it may be. You're here to make money. And the sooner you get away from thematic investing, the better you're going to be in it as an investor.
And what advice would you give to the beginning investor who's cautious and wants to protect themselves, but isn't quite sure how to do it?
Well, if they have a long-term, honestly, this goes against what I do, which is trading. But I trade for risk control. I don't trade just to be a crazy, day trader. Like, we trade fairly long cycles, but we get out when trends end. But what I would do is, as a beginner, is I would just do index ETFs to start off with, like broad index ETFs. Don't take on individual stock risk, okay? But don't buy a mutual fund either, because they're so expensive and inefficient. So just buy a low management expense, say a TSX and S&P 500, maybe a global world ETF, and just and if you want, read my book. You'll read about some of the big macro cycles. if you see the triggers that I talk about, that the big cycle, the big trend may be ending, like when the 200-day moving average breaks, that's one of my rules, by a certain number of days, you can maybe take some off the table by selling a little bit of that. But you don't want to be fooling around with, like, your buddies may be talking about, the latest hallucinogenic drug. I think that was one recently that everybody was getting into, right? Hallucinogenic drug stock. And then everybody's, because they're going to make it legal, everybody's going to be now doing heroin or, whatever the theme was. Don't get a medical, I think was the, theoretical use for these things. But that's just a theme. You have no hard evidence that that's going to happen, and it's not conservative investing. I say just buy an index as a novice investor. When you've got over 100 grand, you start to do your own stock picking, and when you've got over $500,000, you come and see a guy like me. So that's the bottom line, is that you do it, but either way, do it with some knowledge and a plan, and not with your emotions.
Great. Thanks very much, Keith. That was really interesting. And you've opened the door to a lot of new ways of thinking that people can research and maybe even take your course if they want to know more about it. Thank you for being a guest on the show, and we have really enjoyed hearing your insights.
Well, thanks, Ellen. It was great being on with you again.
I'm Ellen Roseman. Thanks for listening today, and stay tuned for the next exciting edition of this podcast. And if you like this podcast, please go to iTunes and subscribe and leave us a review as well. That will help us keep this helpful information coming your way.